What's up, guys? And we are back. Sorry for the MIA. I've been really focusing a lot of time on LinkedIn and then also just some of the back end tax stuff. But straight off the presses, we have the 2022 second half industrial figures from CBRE, and we're going to jump into these. So the headline is Tulsa's industrial market cools during the second half of 2022, but still remains healthy. So some notable things: 2.9% vacancy, that is up from 2.6. We have pretty low absorption, 167,000. Starting construction or under construction also is low, 850,000. And then the lease rate did drop to $5.17. I just want to zoom in here, notate a couple things. So vacancy increased 30 basis points over the first half to 2.9%. This is shocking right here. Net absorption fell from 900,000 square feet to 167,000 square feet. So you must be wondering, oh my gosh, what's happening? Later, it says, however, this decline was driven by a select few submarkets not represented of the overall MSA. Overall decline was due in part to limited high-quality inventory. So that also dropped the decrease of rental rate here too. So pretty shocking from 900,000 to 167,000, but there are some reasons. There's some asterisks next to those. Construction starts and deliveries fell but remained healthy. Decreased by 100,000 square feet. So I'm guessing it was just about 1 million square feet, dropped down to 854. So once again, another notating point is northeast and southeast submarkets. So all of the new construction or all of the construction is taking place in the northeast and southeast submarkets. And deliveries fell significantly from 773,000 square feet to 124. So things not actually getting completed and delivery to the market. Thus, of course, maybe the vacancy rate increasing, and then of course having that high quality inventory coming down too. So just going over the historical net absorption and vacancy rate. So as you can see, in 2017, we were hovering a little under, 3.6%, somewhere around there. This was kind of our lowest at this 2.6 mark, which was the first half of 2022. And then now we're at 2.8, 2.9, it says right here. Now, just as a spoiler alert, I think this is going to go up. I think we'll probably be right somewhere around there as the graph. Hopefully we'll get a net absorption up, and also our deliveries up too. So if we can't build anything and deliver anything, then of course we're not going to be able to have anything to be delivered.
So I want to skip ahead to page 5. As you can see, the price point asking rental rate was a little under $550 right here. That was kind of the peak, dropped down to $517. So I think it was like $537, I believe. I'll have to take a look at the previous one, but that's where it was. And once again, they kind of had the excuse of, hey, listen, we didn't deliver any of this high quality stuff that would increase this because we only had 167 deliveries, 167,000 square feet of deliveries. So even though that got snatched up, it wasn't able to compete with some of the older inventory that was closer to $5 or even smaller, $4 or $3. Some very interesting for the historical sales volume of industrial investment sales. It still outpaced the first half, even in a rising interest rate environment. Now, at the very peak, this was the second half of 2021, $84 million invested in the Tulsa MSA, then keeping very heavy at 65 million. Now we're at 67 million. My guess is with the rising interest rates, that's going to drop significantly. I think that's going to be pretty low. I could see it kind of going closer to 60, maybe somewhere in this $50 million range, somewhere around here to here. When it comes to the whole entire graph, I think that is going to just slow down significantly, even with the Fed, even though our market is really, really tight.
So looking on page 7, as you can see, these years we had delivered a ton of inventory. This is like Amazon, a lot of the distribution space. This is, right before COVID happened. And then here's COVID right here. And then we're slowly getting back up to some, reasonable construction numbers. Now, these are under completion. So, things got dragged out during COVID because of supply chain, but also this includes starts. Now, some noticeable one is Tulsa Commerce Park, that is North Tulsa. So in between Skytook and probably like in the Waso area, really like that area, so north of Tulsa. And then of course we have some big starts here, near the airport, and then southeast, Broken Arrow, Coweta area. There's a lot going on. Now there's a couple in Broken Arrow that are just finishing up, but I think they're accounted for. So a lot of them, once again, two additional projects in the southeast submarket contributed almost 170,000 square feet. Right here is the historical vacancy rate. 2017, we see we're about 4.2, 4.3, somewhere around there, trending downwards to kind of the collective 2.6 and 2.9 at 2.8 for 2022. Really, really healthy, as you can see. Supply chain and supply and demand really imbalanced towards the landlord's favor or the owner's favor. So looking at the data, I have a couple predictions. One, I just want to point out that 2.8%, 2.9% is still extremely low. As you saw on the graph, 2017, you're looking at 3.8, 4%, somewhere around those. I don't really see vacancy letting up just because we aren't building what the world needs now. So back in 20, 30 years ago, there was no need to put a parcel, a package on your doorstep in less than 2 days. Now that has exploded, and once again with the supply chain, everything happening, that's really necessary. Same thing for manufacturing. A lot of things were manufactured in China that got completely shut down. Then with the supply chain issues that we've been having, companies and people aren't even getting their things when they want it. And so a lot of companies are looking back towards the United States to onshore their manufacturing process, so at least they have some control of it. And then on top of that, it's a little bit closer. It's not a whole entire ocean away. So Mexico, United States, Canada, that's a trend of onshoring. So if I was to expect anything, I think that, we'll be in the low to mid threes of vacancy for this first half of 2023. I think that starts of construction and ongoing construction are going to be lower than normal, not really making sense of the vacancy too, because it's kind of imbalanced. I think deliveries, hopefully, Tulasi Park is going to deliver some really nice Class A industrial distribution space. And I believe that they are getting some manufacturers also there too. So that's really exciting. And yeah, I think the industrial sector is really healthy. But what we're still seeing is there's a big gap in between sellers and buyers. I'm getting hit up 8-9% now, and sellers are still wanting their rate of 2020 and 2021 prices without knowing that rates have radically increased. So we still have a little bit of lagging time in between these, and hopefully we can make some things work with creative financing and just focusing on relationships. Well, thank you for listening to me rant about industrial real estate for a long time. I'm excited to put out some more content and maybe do some weekly updates, not just first half, second half kind of things too. Also, I did a pretty big media push, and we interviewed local faith-based entrepreneurs and investors, and so I'm excited to put out that content into the world. If you want to follow along though and get access to exclusive deals, the best way is to sign up for my newsletter, and that's going to be linked below. I encourage you to check that out, and hopefully we will be bringing you a deal sooner than later. But yeah, thank you, everyone.